Yes. Yes, we're good to go.
All right. Well, thanks everybody for joining this virtual roundtable. My name is August Felker. I'm on the board of the Search Fund Alliance. This event was organized by the Search Fund Alliance, which really is an organization that is dedicated to supporting investors and CEOs within the traditional search fund community. We host regular roundtables and annual conference focusing on those topics that really matter most to the traditional search community at any given time. And today's topic was one that many of us have been curious about. Essentially, how do searcher CEOs achieve liquidity without having to give up their original searcher investor base? We've got a great panel today to discuss this topic. It's going to be moderated by Zach Dupree of BankProv. Probably many of you know Zach. He's a fantastic resource for the community and also just a great guy. So Zach, I'll pass it off to you. Thanks so much. And we plan for this session to be about an hour. I think everybody is going to be on mute. But if you do have questions, feel free to post them in the chat.
Thanks, August. And just quick correction, I'm at Professional Bank now. I think you mentioned my former, and it's appreciated. And thank you everyone for virtually attending today's roundtable with the Alliance. We like to thank both April and August for their hard work putting this together. And throughout the discussion, questions can be either submitted via the chat box to me directly, or you can wait till the Q&A at the end. So feel free to ask anything throughout, and we'll try to put your questions into the dialogue today. So today's roundtable topic, it's a conversation about the liquidity options for search fund CEOs. As many traditional search CEOs perform well leading the business, they have the majority of their personal net worth tied up in the business, and for a variety of reasons, might want to take chips off the table or get access to the wealth they've created. And we want to discuss those options, what it could look like, the timing, best practices, things to think about when the opportunity arises, how to align incentives. And today, our panelists can share their commentary and perspectives on the topic as they participate in the ETA ecosystem from a variety of different roles, from investors, legal, to operators themselves. And they've all had experience with CEO liquidity events in the companies. So I think we'll start with a brief intro, just so that everyone on the panel has a little more context for the audience. So I'll just kick it off. I'm Zach Dupree. I'm the director of search fund lending at Professional Bank. And over the last 8 years, I've focused specifically on lending to the search fund and ETA community. And since that first client 8 years ago, I've built 2 nationwide lending platforms for search fund financing, which has done about 75 acquisitions and over 300 million in overall financing. So it's been a really exciting and fun run. But similarly, I'd like to go through the list, and maybe we start with Jim, just to give a quick background.
Hi everyone. I'm Jim Edmonds. I am with Search Fund Partners in Menlo Park, California. And as our name would suggest, we are prolific investors in search funds, and we've seen all kinds of exits and liquidity events over the years.
Excellent. Steve Lee.
So I'm Steve Lee. I'm a partner at the law firm of Goodwin Procter, and I co-chair the search fund practice.
Thanks, Steve. All right, we'll go to Rush McCloy.
Sure. Rush McCloy, ran a search about 12 years ago. I'm no longer in the search fund community. We actually sold our business about 5 years after the search to a private equity fund, and now transitioning that company, but certainly a beneficiary and thankful beneficiary of the whole community, and now just a spotty investor and hopefully helper in any way I can.
Excellent, thank you. Barrett.
Barrett Foster, raised a traditional search fund in 2013, I believe it was. I was fortunate to come across a company called In Charge Electric in 2015. It's a residential electrical construction business, so a little bit different than the typical search fund investment, based in Texas. So we've been running that for about 6 years now, have grown to 8 locations across Texas, and we'll do 135, 140 million this year in revenue. So we've been lucky.
That's great. Thank you, Barrett. And Alex Stavros.
Hi, everyone. My name is Alex Stavros. I ran a search fund that acquired a adolescent behavioral healthcare company called Embark Behavioral Health back in 2011. So have been operating for 10 years. We did a minority recap in 2016. All individual search fund investors remain involved from the beginning in 2011. And I have also been invested in search funds for the past 5 years.
Excellent. Thank you, Alex. And last but certainly not least, Mark Procopio.
Thanks. We've raised 2 funds to make secondary purchases in the search fund space, specifically to provide liquidity for searchers and CEOs and investors, both institutional and high net worth, and anybody else who's on a cap table that needs to get out. But this is pretty much our focus, this topic.
Excellent. I'm glad you're here, Mark. It's great. So why don't we kick it off and just kind of talk some general topics around sort of when do you typically see these types of events triggered? You know, what are the drivers for the liquidity need from the CEO's perspective? Maybe Jim, kick it off since you've been investing in search for quite a while through a number of funds at Search Fund Partners. Can you talk a little bit about just when you see and what triggers the CEOs looking for the liquidity event?
In my experience, the overwhelming motive is the CEO's desire for some liquidity and diversification. They might be really believe in the business, be very excited about the future, love running it with their partners, but they're tired of having an apartment with cockroaches and driving a Crown Vic, and they want to diversify a little bit and take some money off the table and make sure that their kids can go to college and maybe upgrade their lifestyle. And I think that's very understandable. The CEOs who've created a lot of value have a real disproportionate amount of their wealth tied up in the business, and it's pretty understandable for them to want to take some off the table. Secondarily, issues you'll worry about they might have the whole idea of the IRR clock ticking in the back of their minds. I think as a community, we've tried to address that with some changes to the docs. And then also you might see a CEO wanting to create some liquidity to reshuffle their investor lineup, maybe to get more alignment around a strategy shift. But I think those are the things that come to mind most immediately.
Excellent. And over the last 10 years or so, I mean, is this happening more frequently now than it used to? As you mentioned, the docs have changed, maybe to make it easier to realign things. What have you seen, Jim?
I think it happened enough, or was enough cause for anxiety among investors and CEOs that it's been responsive. I think we're better able to have this conversation now, just based on our experience. I think it doesn't serve anyone's purpose to sell a business completely early to get liquidity for a CEO when we're leaving money on the table. And so it's been a dialogue over the years, and I think we're much better at addressing it and being proactive. I wouldn't say that searchers now are any different than searchers were a decade ago in their desires for liquidity. It's just that we're better able as a community to talk about it and address it.
Great. And someone like Alex yourself, I mean, you've been operating for 10 years now, right? 2011 is when you acquired after running your search. I mean, how does this topic come up in your mind as you're operating the business, and when you're thinking about it, and how you like to kind of give people advice in this respect?
So I think similar to what Jim said, the way I think typically this happens is probably around year 5, most often. It becomes clear that the IRR hurdle is going to be met if there's a liquidity event. And so in a way, that initial equity that was granted has been fully earned. And if you do, and then now the majority of your net worth is cut up in this company. At times, like myself, I had school debt still. And so there's an aspect just in terms of what's responsible from a diversification perspective. And also after year 5, you now have probably a larger family. And you usually sit at year 5 still at a more under market salary and bonus structure. And so there's something that all comes together at that point, if there's been success, where it feels like something has to give either. And I think that the salary and bonus is a bigger issue than we might discuss as a group. I think early on, it makes a lot of sense given the structure, that the salary and bonus be lower, given the equity compensation package is so big. But once there's been a successful outcome, there becomes this incentive or push for the searcher CEO to trigger a liquidity event, to get the vesting. A private equity buyer per se likely would bump up to more market salary and bonus structure, and there would be a new equity pool that would be granted. It wouldn't be that big, maybe somewhere between 3 to 7%, which is market for PE. And the searcher could get some liquidity. And not all of those things are important. So for different searchers, different of those components are important. But at that point in time, one of those things has to give. And for me, it was a little bit of all of those that I was trying to solve for, because this is a company that I wanted to lead over decades. And I had a lot of individual investors who really don't have interest in selling and paying taxes and redeploying capital. And if it's a good industry and a good company that is going to provide really long-term, great long-term compounded returns, we'd rather stay. So we had to figure out a way to get a realignment. So that's a little bit of the background on what kind of triggered the need for me.
Excellent. And maybe to contrast that a little bit. Yes, Mark, go ahead.
Yeah, I want to jump in. There's a study that Harvard put out last year that kind of stitches together what Jim and Alex have just noted. And they discussed something called the friction of non-diversifiable risk. And what had happened, I think some of our thinking in the search fund space is mirroring what has transpired. I think Jim mentioned, we're in a different place to have these conversations than we were 10 years ago. And I think we're kind of following 10 years behind the evolution in some respects of the venture capital industry, where they realized that a friction between the boards and management was developing because, of course, the boards were diversified in their risk personally. The management was all in on the one asset. And so they had to figure out some way of not letting that bubble over and providing some liquidity to the entrepreneurs. Like Alex said, you probably have a larger family, right? You've just got bigger responsibilities. And so they began to allow secondary sales of the entrepreneur's equity, but up to a certain cap. And that was sort of an evolution that the venture capital world went through. And they found that actually the returns were better in companies in which they had allowed some liquidity than in ones where they had kind of clamped down on it. It's a study, but it's a data point.
Got it. And I think from Alex's perspective versus Rush. Now, Rush, you had mentioned earlier that after 5 years, you did sell to PE. What was like that decision like in terms of going from a full, liquidity event versus a partial liquidity for yourself personally? Can you kind of comment a little bit on your sort of tenure in that 5 year mark?
Sure. Yeah. So we had gotten just some really frothy offers at the time. And just from a pure, multiple standpoint and other things. So that always gets people, is the market timing now? Oh my gosh, is this a window? And, those conversations naturally pick up steam. And I think as a CEO, and I was excited to stay on for another period of time. But the conversations really the offers that came in were for a full sale. So, and we never explored the other. I actually didn't even think about it. Looking back, I want to say it was a different time, yet Alex, did it far better, I think, in the sense that he was able to think through, how do you get partial liquidity, but if that's the case, you're still going to get those multiples. And so we had a lot of board talk about that. The only thing I want to say is I think there is a part of the CEO, which is important, staying on, getting liquidity. I also think a CEO ultimately serves the shareholders and their best interest, and the board is supposed to represent that. So, and I think what was really important when we decided this is to say, okay, what are is this a real option? The communication strategy was really important with the rest of the shareholders, and not to, my first tendency, quite frankly, if I were honest with myself, was, okay, I'm going to go now caucus and call a bunch of shareholders to see what they think. That's absolutely the wrong thing to do, which I didn't. I want to say that up front, but that's a natural tendency. And I think as a CEO, you have a lot of shareholders, but the board still represents them. And so for me, in that decision process, to say, okay, if this is the board's, they want to sell at this, that is okay. Now let's all be clear very upfront with the rest of the shareholders to understand sort of, is this, within their within their interests as well. At this, but ultimately it's going to be the board's decision. And I found that out pretty quickly, that when the board wants to sell, that's kind of, and they make a decision, you got to just post and march forward. But that was certainly my experience, which was certainly understandable. It was a big valuation and all the rest. And we just didn't, I don't know that we had the option to do a partial liquidity. And we certainly didn't go down the path of, caucusing the rest of the shareholders.
Oh, thanks for that, Rush. Appreciate it. And now I want to kind of go over to Steve a little bit because, in general, Steve, you do, let's call it almost half of your portfolio is specific to search and then the rest to PE. I mean, can you kind of comment a little bit on what you're seeing for sort of partial liquidity events for CEOs and how you're involved in that?
Sure. So, I mean, the most obvious part of our involvement from the legal side is obviously documenting whatever is going to happen. I think the recent trends that we've seen, especially during the pandemic, is that there were some other reasons why CEOs were looking for partial liquidity or trying to get through this. And the big decision point was some of the companies were impacted by COVID, and personally the CEOs needed to have more liquidity just as a result of that, because either a spouse lost a job or you had to pay for additional daycare, healthcare, whatever it is. And we found that the conversations with the board of directors were, really very varied because, in some cases it was, a one-time bonus to essentially, cover over some of the, immediate cash needs that the CEOs had. In some cases, there were, where companies were operating well, it was a time to think about that partial liquidity scenario. And, honestly, in the heart of COVID, the kind of the exit strategy of a complete liquidity event really wasn't an option for a lot of companies. And so what we were seeing, and I guess that probably, during the heart of the pandemic was a lot of those kind of immediate need or emergency needs for partial liquidity. And I found that boards were, pretty understanding about it. I mean, there had to be, some underlying factors, which I think we can talk about later, but, there had to be some underlying success in the operations of the business. There had to be comfort with the CEO's kind of progress towards goals. But a lot of the things that we'd been doing for the last 6 months were those partial liquidity events for covering those kind of immediate things. And then we also had a bunch of investors, searchers that were hitting that 5-year mark where, the IRR hurdles were going to be a little bit more daunting if they were going to continue to operate for, the next 2, 3, 5 years. But as Jim said, the kind of documentation and the conversation around that shift at 5 years has really progressed over the last, call it like 4 or 5 years. And, we didn't see as much of that typical activity that we historically had seen, which was driven by that angst of trying to maintain that IRR hurdle. And I think it's because of, the flexibility of some of the investors like, Jim and Search Fund Partners.
Got it. Thanks, Steve. And so, Barrett, I wanted to kind of discuss your situation slightly differently because you're in a slightly more cyclical industry. You had a different, I guess, more flexible terms relative to your industry because it made more sense for a longer hold period. Can you kind of speak to like your, liquidity event and how you and your board kind of were aligned in that regard?
Sure, happy to. And it's somewhat of a frequent, or I shouldn't say frequent, a recent event for us. We actually got together as a board in Boston in July, all in person, which is kind of crazy to think about doing that. But it was a major decision. And so, we had been running the business for about 5 years at that point. We had seen some success. I think, the investors had done well. Particularly our situation, we weren't worried about, a pref or an IRR hurdle. That wasn't part of the original deal. So I think it's a little bit more straightforward in the calculations for us. But we got together and we essentially, as a board, we came and thought about a couple of things. One, first and foremost, what's best for the business, right? At that point in time, because of our growth and some of the success that we've had, I think we could have gone to market and generated substantial returns. So that was the first question that we had to ask is it in everybody's best interest to potentially pursue, right, a liquidity event? For us, we decided that was not the case. Industry factors, cyclicality, multiples that we could have gotten. There's a dozen reasons why we decided that continuing to operate the business would be in the best interest of the company and the investors. And that's the decision we made. So then I think question B is, okay, if you're thinking of it as in charge 2.0, right? The first 5 years being 1.0, the second maybe 5 years being 2.0, how do we really align everyone's incentives? And that gets to the liquidity discussion, right? I think, of all the people at the table, I was certainly the person that had the lowest net worth, and also the highest percentage of my net worth, right, wrapped up in discharge. And so I think, as a board, we addressed that topic. Jumping to the conclusion, we decided that they would essentially grant me an advance of my equity distribution. So really a risk-free, interest-free loan, if you will. And that would allow me to satisfy some things that, I wanted to personally. And I think a lot of those topics were addressed, right? A growing family, ability to potentially invest in search funds or make other investments on the personal side. And at the same time, I think our solution was one that fit really well with the company too, right? It did not put the business, I think, at dramatically increased risk. It didn't harm investors, right? So I think, our solution was perhaps unique, but really worked out well for everybody and aligned our incentives so that hopefully over the next 5 years, right, we can continue to grow and generate positive returns.
That's great, Barrett, and thanks. And I think everyone's kind of talked a little bit about that idea of aligning incentives, really between the company, the investors, management. How do you see that playing out most of the time, Jim, in terms of, like the CEOs coming to the board, trying to figure out how to do that, and how the board is really looking at that and handling the situation?
Investor's perspective, there's a lot of gratitude to CEOs like Barrett who've created a lot of value. And that's really the hard part. And if that person is willing to stay in the seat and create value for 5 more years, no one wants to stand in their way. I do think that investors are shy about the idea of CEOs getting liquidity before LPs get some liquidity. And so these types of transactions are usually packaged around some sort of, we all get some money off the table. And if that can be accomplished, great. But there's a reluctance to sort of pay out the CEO ahead of everyone else, because that maybe reduces alignment. So I think if you've created a lot of value and you're able to create some liquidity for everyone, people are going to play ball and want to keep and want to work with the CEO, and these conversations should be really positive because it's in everyone's best interest.
Right. And Mark, can you kind of comment here? Because I know a lot of times you're talking to CEOs and trying to help them through like their thought process and whether it makes sense, the right timing, and how to go about that.
Yeah, one of the conversations, and you and I discussed this as well, that when the CEO liquidity and the first 2 tranches, or they have an actual vested asset to deal with, anybody who's going to provide liquidity, whether it's us or anybody else, is going to value the class of security rather than the whole company. So the whole company may have doubled in size, but if it took on a huge amount of debt, waterfall. And so I think to Jim's point, an investor has to look at that and say, well, the relative classes have different values, and I don't think a lower class should be paid out before a higher class, so to speak. So that there has to be something in it for the company and in it for the board to get the deal done, which is where some of the biggest challenges come from. I think also one thing that we haven't really discussed a lot, which I think is kind of an interesting topic, we've been called in on several occasions where there's been a parting of ways between the searcher CEO and the company. And as they leave, they're leaving hopefully with something in their hands, right? And it's been easier, obviously, to bring us in as a third party, but that's also something which happens as well, because the liquidity event may occur because the company is doing really well and the searcher needs to take some cash off the table. It may also be because things have not gone well and there's been a parting of the ways, and it's a way of kind of cleaning up the books, as it were.
That's right. And I kind of wanted to bring Alex Stavros back on now, just about kind of that concept of aligning incentives and kind of working through that with your board, from trying to determine, what you were looking for and trying to get everybody on the same page to change what was in place. Can you talk a little bit about that more specifically?
Yeah, sure. I think it's important to board. I think there's an important role for boards to become very competent at having these conversations, because the CEOs aren't, and it becomes difficult. And I think more often than not, it gets more emotional than it needs to be, and we really see it as a market. And let's confront the brutal facts, how we're structured, and what's the best way to resolve this. And I think in every case, it can be a little bit different. Baird had mentioned in terms of the loan, I think that partly it depends on, for example, the amount. And sometimes it's just, as I mentioned before, it's a salary and bonus issue, and then maybe a small amount, and that can be a loan, and you wouldn't need to trigger all the investors wanting to get liquidity too. I think once you pass a certain threshold, that means other investors are going to be interested, or would want to see what's going on. And I think that definitely 50%, a CEO selling 50% or more, is one where we have to take a hard look at maybe the whole company should transact. And again, I'm only talking about successful outcomes in this case. I think non-successful outcomes is a different story. But one of the things that worked well for us is that we were able to find an investor. Now, it was difficult because the investor had a minimum amount they wanted to invest. But what we're able to do is we allowed all shareholders to sell as much or as little as they wanted. And so if they really liked the deal and they saw the CEO was taking some liquidity and they wanted to get completely out, they could. If they didn't want to sell anything, they didn't. And so in a way, that's what creates, in essence, what I mentioned at the beginning was the market. And it becomes fair, because it's really hard to create a structure where everybody feels good, because everybody has different situations. So ours worked out well because some investors didn't sell anything. Some sold, none of them sold everything, but some sold up to a half. And all of them wanted to stay in, but they were able to make those decisions individually based on their views of the company, their personal situation, and the valuation that was in front of them.
Hey, Alex, can I ask you a question? When you were finding that new investor to come in, how involved was the board at that point?
I led most of the process. So we did a mini process with a banker. Part of it was to figure out what the valuations are, what the multiples, and a little bit to Rush's comment is we needed to understand. We wanted to have a valuation. We knew that it was going to be discounted because it was going to be minority, and we had other aspects that were important to us, but we didn't want to be too discounted. So we had to have a general idea of it. And I think in that process, if we would have found this really high valuation, it could have been that the board would have decided, hey, we should just transact the full company because the valuation is too high. So we were talking to a few bankers and getting them to pitch to us and give us an idea of valuations. And then I was having most of the conversations. So we got a few LOIs. And then and through that process, I was constantly going back to the board, but that was definitely something I led versus the board led, but it was complete transparency in terms of sharing all the information so we can make the best decisions.
Well, thanks, Alex and Steve. I was actually curious, Rush, for you, were you going through evaluation process outside of sort of like what the offers were coming in? Like, how were you guys determining, the multiple and the frothy market at that time was the right time? Because the valuation topic is very interesting when it comes to like a partial liquidity event. So Rush, can you comment on that a bit?
Yeah, so there had been a couple firms that came in and just put some big offers on the table. This is pre-process. But then, of course, if we went through the process, would that go higher? This is sort of the anchor. And so that's how it started. And therefore, we went through that. We did a lot on our own with the with prospective buyers, as I think in any process. And then obviously it was constant communication and updates. I mean, there's a very formal process that we did with that. I think one of the things is in going back to the process and the communication, leading it, just putting your best foot forward is really important. I think there's a part of it though that is a slippery slope when doing a full sale, because as a CEO, you become both a seller and a buyer, depending on the acquirer. And I know personally, I felt that, and it's hard to know. It's almost like when you're searching for a company, at some point you lose your objectivity and you're no longer true. Yeah, you're just not objective. You want to do it no matter what. And you start to make up things to make sure that it's good. At least those that have you, many are prone to that. I'm not saying everybody, but that is a tendency. In this case, what becomes a slippery slope is when your allegiances start to shift. And so during that process, knowing, okay, I'm a seller, but I'm also, if it is a PE buyer, there's an expectation of a significant role. So I'm now a buyer of the selling price, and the economics in the PE world are not going to be the same as in the search fund world. So I'm buying I'm pari passu buying that stock at that price, but and the sort of CEO economics are going to be very different going forward. So at some point, not forgetting your allegiance always has to remain with those who really, put forth, and still you have the fiduciary responsibility to the former shareholders, but just being very knowledgeable when your allegiances start to shift, because that can be a tendency. And then the other thing that I think was kind of interesting, if I were a shareholder on the board during that period, I would say I would have a bench of CEOs who have sold in a very similar transaction, and to say, hey, look, because let me just take a step back. When you're sitting there trying to balance all these different constituents, at some point, if the sellers say, oh, no, that's a good deal, that's a good deal. Well, I don't know that this is a good deal for me. And you may not have as much perspective. And there is a natural bias for the sellers to want to sell at that price, but you're owning that going forward, right? I mean, you want to be a good fiduciary you want to be responsible to them, but you're also owning that. So there's a fine line there. So if I were on the board, I'd say, look, objectively, I'm not going to tell you what's good or bad. I think here are 15 people you can call, take your pick. They have gone through it and they can tell you some of their perspectives of what's a good deal, bad deal. I remember when I went in, wait, this non-compete, holy cow, it's like, lock me up here, it's lock me up there. I mean, I feel like my hands are tied, and this equity, what? I'm going from this much to this much. This seems crazy. This sounds horrible, right? Well, actually, that is the PE world. It's just a very different world. And getting those objective, those perspectives, I should say, are going to be really important in going through a process. And so while you manage it yourself to try to get the best sale price, show the company the best position, at some point, like having close communication when it comes to your own personal economics, I think is a really important thing with your former shareholders. It was a convoluted way of saying that, I know, but it's a really funny process. At least it was for me. And I went alone too long. And then the more I communicated with the board, the better it was. So I didn't feel like they were like pushing me into economics that would potentially be bad for me going forward, because they were actually very good and they were market.
Got it. So you were going through that process alone for a big chunk of it, right? Because you didn't really have folks to go through this with and understand different perspectives.
Yes. I mean, in the beginning, it was like huddling up by myself, and, I had a partner and we're talking to lawyers and we just weren't sure. But at which point, when we took a step back and then we were able to reach out to people and say, hey, look, just don't tell me what's good or bad. Who can I speak to that can give me good objective perspective? Is a 10% management pool for a PE fund, is that good or bad? How much of that should I get? Is it 15%? Can you go for that? Your salary is going to be better. What should I be what is market? What could I be going for? What should I be balancing out? What should a non-compete look like? Because ultimately that is required to get the deal done. So you want to get it done for your shareholders, but you also don't want to get it done without, screwing yourself for the future. And so again, you're a buyer and a seller at the same time. And that is sometimes a pretty tricky thing to manage. At least it was for me. Maybe for others it's been better. It was a lot easier after I just spoke to people.
Yeah, it's an interesting balance to walk, and maybe going to a partial sort of liquidity event rather than selling the whole business. Barrett, can you kind of comment on how like it sounds like you guys got together and really figured out the best path forward for the business. But I mean, how do you determine that fair, market valuation without running a full process with bankers and going through a longer term play? It seems like you guys got together, came up with a plan, and were able to execute. Can you kind of comment on the valuation side of it to value your equity?
Sure. So, well, first of all, so we didn't get there. Thankfully, we didn't have to go there. But I think from a valuation standpoint, it's incredibly complex, right? Depending on the industry that you're in. Our industry, I think, is difficult to value businesses like us. There's not a lot of transaction history. There's not a really dynamic market, if you will. And I think if you're talking about a minority exit, especially one in which the CEO is potentially selling some of his shares, and whether or not other investors would be, theoretically allowed to, I think it gets extraordinarily complex. And at the end of the day, right, the only real valuation is what somebody's willing to pay for the business. I wanted to avoid all of that, which is why during our meeting in July, I came to the board with, a pretty strong recommendation towards this, advance of distribution concept and some, carrots for the investors as well from a liquidity standpoint from them. I think that if the board had determined that that wasn't in the best interest of the business and the shareholders, then I would have had to pursue, a minority stake, a minority sale. And I think, there's a couple reasons I didn't want to do that. One, I think I knew I was going to get a discount on the value of that equity. Anytime, I think there's a minority sale, especially when it's for a particular reason for either the CEO or an investor wanting liquidity, right? They're going to get a discount, and they should probably get a discount to the value of the equity. So I wanted to maintain my whole stake. I believed in the business. I wanted to, kind of double down on that risk. At the same time, right, for personal reasons and whatnot, I wanted the liquidity. And so we were able to get there without having to go through that valuation process, which I think is just incredibly complex, and at times can put people at odds with each other, whether it's investors at odds with the board, shareholders, things like that. And so, like I said, we were able to avoid it, and I'm pretty thankful that we were.
Got it. And so, Mark, you guys are looking at this quite a bit in terms of like the value of that. Can you talk a little bit about how you guys determine that, what process you're going through in terms of the valuation?
Sure. So we start off with using whatever the is to buy the business in the first place. And then, whether it's 45 times this or 3 times that or 7 times something else. And then we're fairly generous on making adjustments to businesses. Not every industry. Most industries have sort of natural threshold, right? If you give above $1 million in RMR, if you give above 10 million in ARR, those kind of things have sort of a thresholds where the multiple gets expanded. And we do that. And then we go through and take a snapshot of the business as it is right then, paying off the debt and paying off the from shareholders, the class of securities that we're buying, whether we're buying it from a CEO, whether we're buying it from an existing investor, and then apply some sort of a discount to it. As Rush mentioned, there's always going to be a discount, certainly from our business, there is in the secondaries world. And in looking for that discount in science, we think about it internally. We think about what kind of firm would be the natural buyer of this business if it hadn't been bought by a search fund. So, in the secondaries world, and maybe a lot of you guys are familiar with these discounts, but the top buyout type of companies, you somewhere around NAV. That's agreement with the never not agreed on. So, a very solid, very good company bought by a very good private equity firm will be at 90-some-odd% of NAV. A speculative, software development venture-backed company might be 70% of NAV. And then growth equity companies kind of fall somewhere in between, usually in the 80s. And that's kind of where we try to peg things. So think about who would be buying this business if it wasn't for a search fund.
Got it. And Steve, you've seen a lot of these over the past couple of years, even specifically COVID related. Like, what are you seeing in terms of like, are performance hurdles being restructured? You know, Alex had mentioned previously, sometimes it's maybe just about a salary negotiation more than like the liquidity event. But like when you see these liquidity events or specific partial liquidity events for the CEOs, are you seeing restructure of the sort of performance metrics and hurdles for that CEO?
Not as often. I mean, typically, and I think Barrett's example is a really good example, because my experience is that the conversation really starts about are there other ways that we can, accomplish the CEO's goals without actually going through the process of doing a minority buyout or partial liquidity event. And that could take the form of, like I said, one-time bonuses, increases in salary, advances on distributions, like Barrett had said. And so typically, at least in the last 7 months or so, we haven't seen a lot of minority, or partial liquidity events. But in the 1 or 2 instances where we've seen a partial liquidity event, there wasn't a restructuring of hurdles. It was the expectation that you're getting some of your equity off the table, but all of the performance hurdles remain the same. And I think in both of the cases that we've done a minority deal, the hurdles had essentially a flip over to a multiple of invested capital at 5 years anyway. So there wasn't really a real need to restructure performance hurdles.
Got it. And Jim, I mean, is that something you're seeing as well in terms of these liquidity, like the partial liquidity events for the CEOs, right? Because it seems like, downside risk is you have a good performing company, you might lose the CEO. So you want to keep them happy and everybody wins. So really aligning incentives. But at that point in time, are you guys doing a restructure of any of the performance hurdles?
Not really. I think that's all been addressed with the sort of conversion MOIC, and if someone doesn't have that in the docs, you would perhaps rewrite the docs to allow that. But most of the searchers now have that, I think in situations where the performance hurdles are out of reach, it's sort of like the mediocre situation, but there's still sort of agreement that that it's worth holding on to for a few more years. I think boards would probably more likely want to just sort of give a transaction bonus or something that's more in their discretion than changing the performance hurdles, because that can be a can of worms. And there's, concerns about precedent. So there's an acknowledgement that, hey, the searcher needs some more incentive to stick with this for a few years. Let's give them a bonus. Let's not throw out the old performance hurdles.
Okay. And can you kind of comment maybe on what you see as the biggest impediment to achieving some form of liquidity event for the search CEOs? If someone's been operating for 3 to 5 years, for whatever reason, what seems to be the bigger challenge in having that happen?
I think probably the biggest challenge wouldn't be from investors. It would be that maybe the CEO overrates the value that they've created, and there's not willing buyers on the other side. So if you want liquidity, but you haven't created a lot of value, it's gonna be hard. But I think, in my experience, investors are pretty receptive to work with awesome CEOs who are busting their butts to make us money. Who wouldn't? So I think it's just who the counterparty is. But Mark has come and done a few of these, and you've got Pacific Lake. So I think there are more counterparties interested in these kinds of things. It's just a question of can we agree on the valuation?
Got it. Because if you have a great business, a great entrepreneur, I mean, everyone's sort of incentivized to continue.
Exactly right.
Thanks. And Mark, I mean, from your perspective, because you're looking at a lot of these and a lot of them just can't come to fruition for whatever reason. Can you talk about what you're seeing as the biggest impediment, in terms of achieving that liquidity?
I think Jim hit the nail right on the head, which is that there's a gap between the perceived value of how much has been created and what really the asset is worth. I think coming to I forget who mentioned it, but there's always that risk where if the deal is too good, everybody else will jump in on it. So from an execution, so you have the valuation issue, which obviously has its challenges, and then there's kind of an execution standpoint too for the CEO. If the deal is very, very good, like it's almost too attractive, then other investors will jump in, and given the way that the operating agreements are structured, they could crowd the CEO out, and so that they could initiate a transaction and is getting liquidity and anywhere near as much. And there's also a bit of a transaction risk, complicated to. There's multiple, notice provisions, sorts of things. It just takes, Jim's point about getting the if the value is too good, then everybody else will jump in, and the CEO won't get the liquidity that they were hoping for.
Got it. Excellent. And go back to Alex just a little bit on this topic. So, your process, you've been running a company now for a decade, about 5 years in, you went to the board and tweaked it. I mean, like, what were your biggest challenges going through that process?
I think it was, it's becoming more commonplace, but again, just to emphasize, I think these conversations should be more straightforward when there clearly is a vesting of the performance hurdle. That if we were to do a process, that there really isn't any debate, and I think those are but to Jim's point, if you have these outcomes that are kind of in the middle, I think that's a different roundtable in a way. It's a different conversation. But if you have a CEO that's has basically vested all of their performance units from the initial to the time, because if there's a transaction and the performance hurdles, there's a question the CEO's mind is like, well, what do I do now? Because a transaction would clearly vest all of it. And typically this happens in private equity companies where you have a vesting. And so as soon as that's vested from a CEO's perspective, okay, now's a transaction because a new pool is created and it's just replenished again. But in the search fund world, that doesn't exist. So at what point do you kind of move to the next stage? And so part of the challenges we ran into is that then there was a debate about, well, how much should you be able to take out? And so some board members, investors may say, hey, we've heard that a search CEO should never take more liquidity than X dollars because we need you to have skin in the game. If you take more than that, we worry that you're not going to be as hungry. So this is your limit. And if you want more than that, then let's sell the whole company. But this is when I did what Rush said, is I ended up talking to a number of our investors and people had different opinions. It wasn't that clear about what that number was. And if there even was a number where, hey, we want to keep you hungry so you can't take out more money than X. But that mindset really at that point, 5 years in, you're not as much of a new CEO, you're more comfortable in the industry. You're thinking, well, maybe then it is time that I've matured into a private equity type company. But the reality is you talk to your individual investors and they'll say, we don't want to sell. If you want to be a CEO, you love the business, love the company, we want to be in it, we don't want to sell. And that's where I would say, well, I'm kind of stuck now. And so how do we solve for this? And then the question ended up being is that then that certain board members or investors would say, we can't do any transaction unless everybody sells or everybody is allowed to sell as much or as little as they want. So you can't do hey, we're going to force sell a minority of the company, 30% of the company, and everybody's got to sell. We're not on board with that. And that was the first stance. And you talk to some investors and they say, well, that's not ideal, but if that's what needs to happen to get the outcome, then we can do that. But all that process was over months. And I think that it can be packaged a lot. And again, this has to be, in my mind, there should be no debate that third tranche of performance units have been earned and vested if there was a transaction. There should be really no debate. And in that case, I think that there should be just a more efficient way, particularly now that you have certain investors, be it Pacific Lake or Housatonic, that can come in. They may not give you the full process valuation all the time, but as Mark said, I think as long as it's anywhere between 20% of a discount, that's from what the board would feel, from what we know and the due diligence we've done. Hey, this is within 20% of likely what we get on the full process. Obviously, we have no idea. Then you can do that transaction. And I think that we as a community have to figure out how to make that easier, because I've spoken to a number of CEOs where in my case, I was this close to transact. It would not have been in the best interest of the investors. And not me either, because I wanted to stay with the investors. I love this community. I love their support, their mentorship. But when you get to this 5-year mark and things, the other thing is I think Mark had also mentioned that research, you move at the year 5 to more of a CEO that starts to think more about capital allocation versus learning the business and executing it. How do I allocate the capital? The problem at that point is you're not aligned with investors because you don't have the same equity, you don't have vested equity. So you can't really think about stock buybacks and dividends and acquisitions in the same lens, in the same way. And so once there was a way to trigger all of the equity vested, now I'm pari passu with investors and I sit on a board. I'm not really literally the biggest shareholder. As the CEO, there's complete alignment at that point. Prior to that, there are a number of small misalignments, and it's hard to grow a business over a long term when we're really thinking about capital allocation as the primary role of a CEO. So that became an important component too, and I think that we as investors and boards need to do a better job in those particular situations, really framing for the CEO how we can structure this so we can keep on doing this for another 5, 10, 15 years.
Got it. No, it's really insightful. Like, so really creating a phase 2 for people who are top performers doing really well and kind of creating that next growth stage of the business. Interesting. Well, as we get close to wrapping up, I want to take some questions from the group. So what we can do is if you have a question to ask, you can hit the raise hand button and then ask it directly by taking your Zoom off mute. It looks like the first question that we have is from Vito. So do you want to jump in there, Vito, and ask?
Hi, thank you, Zach, and thank you for the panel. It's great session. My question was, pretty maybe simple, but I was asking, if you have someone coming in, either a private equity or any other sort of investor that takes a minority, how does this, in your experience, impact then when maybe other 5 years have passed the exit, either in terms of these large shareholders wanting to drive the process or valuation differentials?
So really like how a minority shareholder could impact the later exit? Is that the question?
Yeah, that's it. That's the question.
My experience, there's no hard or fast rules. If they're really experts on the industry and they're joining the board, they'll have a lot of impact on those discussions and a lot of value added. If they don't necessarily bring a lot of specific expertise to the company and they're more just financial, they're a minority shareholder, they're probably not going to be able to drive an exit, and it'll be the incumbent board and the CEO who will direct that. So it really depends on the nature of that minority investor.
Yeah, I think that's right, because if it's a private equity minority investor, in some of those instances, they're gonna require a lot of consent rights and some other like additional information rights and things like that probably don't have a ultimate impact on the ultimate exit, but it could, it will change the operational flow from a day-to-day perspective in some cases.
Thank you very much.
Thanks, Vito. Yes, Kieran, do you have a question? It looks like hands up. If you could just take yourself off mute and ask.
Yeah, thanks, Zach. Yeah, following on from Vito's point, similar scenarios with a minority investment, how would you have experience as to how minority investments affect the entrepreneur's carry or the vesting, especially kind of pre-time vesting and this kind of thing?
So how would a minority shareholder impact the carry of the searcher? Is that the question?
Yeah.
Mark, do you want to answer that one?
Well, in a typical secondaries transaction, it's just a private sale between the owner of the security and the entire enterprise, because of course you're not in the whole company, you're just valuing the security that's being purchased. So it shouldn't have any impact on the long-term it doesn't reset any economics. It doesn't set the numbers to be higher or perhaps more difficult or easier to achieve for the searcher, because it is just a private sale between two parties. If there's been some sort of an intervening strategic investment where they've come into the cap table and that's actually changed the operating agreement in some fashion, as a secondary buyer, we just agree with everything, right? We sign a joint agreement. But as Steve mentioned, if you have somebody who comes in at a meaningful stake and buys out lots of investors and asks for a whole bunch of different sorts of consent rights and different things, that may change how the IRR calculation is done over time, and then of course how it would impact the third for the searcher. In a straight sale, CEO gets partially for some small percentages shares. I can tell you that from other areas, whether it's in venture capital or buyout or real estate, where other people are seeking the executives, that's just, I tossed it out there because that kind of question has come up as to what number investors may be able to swallow. It's usually about 2% where they begin to draw the line, so you can't sell anymore. But for the purposes of calculating the last tranche of shares, a secondary window will require a much larger transaction and actually affect the opening.
So Mark, I think you're breaking up a little with your bandwidth might be a bit low. Let's see, is there any other questions from the group? Thank you, Kieran, I appreciate it.
Thanks.
Excellent. Well, at this point, I'd like to just thank all of our panelists, Steve Lee from Goodwin, Jim from Search Fund Partners, Mark, Barrett, Rush, and Alex. Really appreciate the commentary today. August and the Alliance, really appreciate setting this up today. I think it was a really interesting topic to discuss, and it's an area that I think a lot of people learned a lot about today. So I appreciate the time, and everybody would appreciate it. And thank you very much. Have a great,
Thank you, Zach.
a great rest of the week.
Thanks, Zach. Thanks, August. See ya.
Okay, guys.
Thanks all.
Thank you, August.